this webinar presented by Guy Wagner on our flagship fund, BL Global Flexible Euro. The strategy is based on a flexible allocation between different asset classes with traditionally low correlation. The objective of the fund is to generate a positive inflation-adjusted real return over the medium term, with a particular focus on reducing downside risk during equity market corrections. As at the end of March, on a year-to-date basis, the fund is down -2%, outperforming its Lipper category, which is down by 4%. The fund has been integrated in ESG factors at various levels of its investment process for more than a year now. The CSSF just confirmed its Article 8 classification under the SFDR regulation. The fund has also recently received the French certification label ESR. Before we begin, a few words about Banque de Luxembourg Investments. BLI is the asset management company of Banque de Luxembourg. We manage almost 16 billion euros through four main asset classes: equities, bonds, and diversified. Our investment approach is based on active, conviction-based, and long-term management. You can ask questions during the presentations using the Q&A systems of WebEx. We will answer them at the end of the webinar. A summary of the conference will be made available in the next few days in French as well as in English, alongside with the video replay. And now I leave the floor to our CIO and manager of the BL Global Flexible Euro Fund, Guy Wagner.
Thank you, Françoise, and thank you very much for listening. So I will start by sharing my presentation. Okay, so basically what I wanted to do during the presentation is to, first of all, to speak a little bit about the economic and financial environment, and then transition to the fund and how the fund is structured in the current environment. So economic environment, obviously the main point nowadays, that's where the market is most obsessed with is inflation. Inflation, we all know inflation has gone up last year, starting more or less in April of last year. And in the beginning, the central banks were saying inflation, this rise in inflation is only temporary. But we've seen since then that at least until now, inflation has remained at very high levels. The inflation rate in the OECD countries closed last year, 2021, at its highest level of the year. And this year, obviously, with what's happening in Ukraine and the Russian-Ukraine situation, inflation has remained very high. And it's when you look at most of the comments, analysis, etc., it's now the main topic is inflation. And the impact of higher inflation on the financial markets. So first of all, maybe one or two words about inflation. Clearly, in the short run, what has happened in the Ukraine and the impact of what's happened in the Ukraine on the world economy is essentially through commodity prices. Ukraine and Russia have not been integrated into the world economy very much as consumers, but obviously they are very important as producers, energy, especially for Russia, food for the Ukraine. And with the war in the Ukraine, what we've obviously seen is this spike in energy prices, and in a situation where anyway the supply-demand situation for a lot of commodities was already quite leading to higher prices, because we will have an increasing problem when it comes to supply for a lot of these commodities, and this situation has only been reinforced by what is happening in the Ukraine. So that all things being equal, that obviously means that inflation will remain higher for longer. Second point, and it's always, as a contrarian, it's always important when you look at the market, and when the market is so obsessed with one topic, you must always wonder, could something go in the other direction? So nowadays, when everybody's obsessed with higher inflation, could the market be surprised by inflation coming down in the coming months? I think there are some points that one has to remember. Some of the factors behind the increase in inflation last year were obviously temporary, and these should improve going forward. And then one should not underestimate also the base effect. So last year, as I said before, inflation started really to rise in April. So come April, when we look at the numbers, inflation numbers for April, May or June of this year, they will be compared to April, May and June of last year, where inflation already had risen. So obviously there's this base effect, which should lead to lower inflation rates going forward. That is not to say that we foresee inflation to fall back into this 1 to 2% range that we've been accustomed to over the last years. I think there are longer term a lot of factors which should maybe lead to higher, structurally higher inflation rates, maybe not at the levels that we're seeing right now, but higher than the 1 or 2% levels that we had in the past. And maybe even more important, I think there are a lot of factors pointing towards more volatility when it comes to inflation. So periods of higher inflation followed by periods maybe of lower inflation, and then again periods of higher inflation. But I think what has definitely changed is that there are some of the structural factors which had led to this low inflation environment of the last decades, which are changing. As there's this challenge to when it comes to globalization. So more and more again, countries want to have at least part of their supply chain back in their region. And if you assume that globalization has led to disinflation, then this relocalization should lead, at least temporarily, to higher inflation. And there's also basically this idea that we were accustomed to, this idea that there would always be an overabundance of labor supply and of commodity supply, and now we're seeing that this is changing. So commodities, more and more there's a supply problem, but even for labor, with the declining participation rates, with the demographics, etc., we are now seeing that labor going forward might be in less supply than what people were thinking, and then obviously that leads to higher wages, and higher wages typically leads to higher inflation rates. So again, I would say, to summarize, when it comes to inflation, one should not forget that maybe going forward inflation rates might come down a little bit, because again there were some factors which were temporary, and you have the base effect. But longer term, a lot of the factors that we're seeing nowadays seem to point towards higher inflation than in the past. Second point when it comes to the macroeconomic environment is growth. So you have inflation, you have growth. Growth here you see the JP Morgan Purchasing Managers Index. So it's both for services and for manufacturing. And you see that right now growth is still quite robust. The way the index is looked upon is when the number is above 50, we are in expansion. Below 50, we're in contraction. So we remain above 50, but there are now some factors that seem to point towards lower growth going forward. Again, right now, growth for the moment at least remains quite robust. But going forward, first of all, you have obviously the expiration of a lot of the stimulus programs that we've seen after the pandemic, that are now being cut back, and which will lead then to less public spending. But then you obviously also have the impact of inflation, high inflation leading to a decline in disposable incomes when it comes as adjusted for inflation. So that should weigh on consumers' confidence, and it should also weigh on consumption. And consumption in the US, for example, is nearly 70% of GDP. So if people have less money disposable for the typical, let's say, discretionary consumption, because they need more of their income to fill up their cars or to heat their houses because of higher energy prices, then obviously that will have an impact on consumption going forward. And also higher inflation leads to a rise in the production costs of companies, which again then means that the companies' profit margins are falling, that with a certain time lag should lead to lower investment. So then you have this negative impact on both private consumption and private investment, combined with less public spending. All this together should point towards lower growth. So clearly, and then obviously also you have the rise in interest rates that we've already seen, especially when you look at bond yields in the US. It's always that the US economy is a long interest rate economy in the sense that rising bond yields have an impact on mortgage rates, etc., etc., and that then leads to lower consumption and to weaker growth with a certain time lag. So all this put together, clearly the environment for financial markets, the macroeconomic environment has deteriorated, and the environment for financial markets has deteriorated in the past months. Linked to that, and obviously that's the other big change that we've seen over the past months. So one was the rise in inflation. And the other one is this change in attitudes when it comes to the central banks, when it comes to their monetary policy, when it comes to monetary tightening. 1 year ago, or 9 or 12 months ago, central banks were still saying no monetary tightening in 2022. I think one of the members of the Federal Reserve was even saying they're not thinking about rising interest rates. And now 1 year later, the attitude of the Federal Reserve has completely changed. Here you see what the market is currently expecting when it comes to the Federal Reserve interest rate, and clearly so we're now in an environment where central banks are starting to consider the fight against inflation as their top priority, especially obviously in the US. And so from that point of view, environment for financial market, which has changed, whereas 12 months ago, most people were not necessarily expecting an interest rate increase in 2022, at least not in the first half of 2022. Now, if we've already had the first rise in the US Federal Reserve target rate 2 weeks ago, and clearly when you look at what Powell or the other members of the Federal Reserve are saying, all this is pointing towards a more aggressive monetary tightening. Linked to that, and obviously the long-term interest rates, bond yields have also increased. Here you see the 10-year US government bond yield, and the rise in the bond yield has been quite spectacular. Since the beginning of the year, the interest rate has nearly doubled, going from 1.2, 1.3% to 2.6, 2.7%. So we're now approaching the 3% when it comes to the US government bond yield. In that sense, what's also interesting is that even though the Federal Reserve has only now started to tighten its monetary policy, the 2-year bond yield already has increased quite a bit, and people are always looking at the form of the US yield curve, and we're seeing now that there's no longer a big difference between the 10-year bond yield and the 2-year bond yield, and we could even have the yield curve inversing, which generally is considered a sign of an approaching recession, or at least of an approaching sharp slowdown in the US economy. So again, that's another sign that some people are looking at to point towards quite a major slowdown when it comes to the economic growth. So that's the situation right now. Going forward, I think it's obviously the question then becomes how far will interest rates rise? Will the Fed really become as aggressive as they seem to imply right now? And where does the long-term bond yield in the US, where does it, until which level does it go? We still, our working assumption is still that there are different factors limiting the potential rise in interest rates, and obviously the most one is this one. It's the high debt level that we have in the global economy. This is the global non-financial debt compared to GDP for the world economy, and we are at historically high levels, and you would assume, common sense would assume, that if the cost of that debt rises too strongly, then the impact on the economy and the world economy will be quite strong, and that then again will lead to lower interest rates again. So again, that's our working assumption right now, at least, is that given these high debt levels, we don't think that interest rates can rise enormously. And we also think that in the end, when we will look back upon this period, we will see that the Fed in the end will not be as aggressive as they now implying, and that bond yield cannot go too high, because again, there will be too many problems if interest rates go up too much. So that basically should mean that interest rates, generally speaking, will remain quite low. This is basically simply for the industrialized countries, the average interest rate. So all maturities are taken into consideration. The orange line is in nominal terms, blue line is in real terms, so adjusted for inflation. And basically the idea is simply to say that we think that real interest rates will remain in negative territory. And obviously for the equity markets, it's a big difference. Sometimes people say equities are a hedge against inflation. That's not necessarily true. If higher inflation leads to a very strong increase in interest rates, then obviously equity have a major problem. However, if high inflation does not lead to that much higher interest rates, and so interest rates remaining negative in real terms, then equities, at least certain kinds of equities, can act as a good hedge against inflation. And I think that's the environment we as at least believe that we're in right now. The increase in inflation also means that another thing which I've already touched upon before, and it means that basically when you look at asset allocation, when you look at the structure also of a balanced fund, you can no longer simply make this distinction that we all in this business are very used to making. The distinction being that one considers equities as risky assets and fixed income and cash as low risk assets. That makes sense in an environment where your definition of risk is volatility. We all know that equity prices fluctuate much more than bond prices, and in that sense, if for you risk is volatility, then obviously equities are more risky than bonds. However, I think that in this the current environment with very high debt levels, with rising inflation, the risk is no longer volatility. The risk is that you lose part of your capital, or at least that you lose a big part of your purchasing power. And I think that's in this environment, that's clearly nowadays the risk. The risk is not volatility, quite the contrary. Volatility is the price to pay to still generate a decent return. But the risk is a lasting loss of purchasing power. And if you accept this definition of risk, then obviously you can't simply make this distinction and generalize about one asset class as being this asset class being risky or not risky. So I consider some of the equities I have in the portfolio as being, let's put in on the more high risk side, but others are on the low risk side. For bonds, you could say the same, and for currencies, you could say the same. And basically, what I'm trying to do with the fund is to find a good balance between, let's say, attack and defense, between risk on, risk off assets. But again, I'm not willing to simply consider all my equities as risk on or all my bonds as risk off. It's really this distinction that is very important that one should make. And that's why I always saying, when people look at my equity allocation, and if it's 70%, for example, they might say, okay, the fund is right now that seems quite risky, and if it were at 30%, they might consider it as very low risk. I think that this kind of way of approaching things doesn't make any sense anymore in this environment. What I also always wanted to do is people tend to generalize. What I did here, I have 3 examples where I say stock picking versus indexing. I took for 3 different markets. Here's Europe, and the US and Japan, a period where the index lost a lot. Here is Europe at the beginning of the of the year 2000. So between 2000 and March 2003, the index lost 50%. But that didn't prevent some of the equities that we have in the portfolio that we've had in the portfolio for a very long time to still be able to generate a decent performance during this period. So again, it's also one of my other obsessions, basically this idea that you can't generalize, and you shouldn't simply say, okay, if I'm negative on the equity markets, that means I'm negative on each and every stock. I think that doesn't make any sense. And again, here you see that names like Reckitt or Novo Nordisk during this period did quite well, and even Unilever, especially if you were to take into consideration the dividend, then even despite a 50% drop in the index, these companies were still these stocks still managed to generate a decent performance. Next graph is the same for the S&P. It's again 2000 to 2002. The index lost 40%, or even until September, even nearly 50%. And despite this very strong fall in the index, companies like PepsiCo or Federal Express or Johnson & Johnson did quite well. And even more extreme, Japan in the 90s, so between beginning of the 90s and September 98, index lost 70%. But again, you had names that during this period were able to protect the portfolio to a certain way and to generate a decent performance. So again, all these three examples simply to say that let's stop generalizing about equities by asking questions, what will equity markets do, etc. I think stock picking has again become much more important than in the past. So if I were to summarize then the macroeconomic situation, this is a graph I'm sometimes using. Basically, when you look at the macroeconomic situation and you divide macroeconomy between growth and inflation, there are four possible scenarios of positive growth with low or high inflation, and scenarios of negative or at least very weak growth with high or low inflation. I think clearly now the scenarios on the bottom with low inflation right now, we're not in this type of scenarios, given that inflation has increased. We right now, I would say, in the upper right-hand side, so inflationary expansion, maybe not high growth, but still decent growth and high inflation. And then the question becomes, where will we go from here? And each of these quadrants, each of these scenarios, in each of these environments, you have asset classes doing well, or some of the asset classes are doing better than the others. Let's put it this way. I would say that generally speaking, it's an environment where gold should be part of a portfolio. Equities, you can discuss about the weighting. Generally, again, here we are generalizing to a certain degree, but it's still an environment where I think you should have an equity bias. Bonds in this environment obviously have trouble performing very well because interest rates are low and inflation is rising. So again, right now I would say we're in the upper right-hand side part of the graph, and then we'll have to see where we'll go from here. But again, it's still, I think, an environment where real assets, and especially equities and gold, should be referred to fixed income and cash. So how is the portfolio then structured here? You have the asset allocation at the end of March, 73% in equities. Around 18%, a little bit more than 18% of the equity exposure has been hedged. So, in March, we started to hedge part of the equity portion of the fund. Why? Because, as I said before, generally speaking, the environment for equities has deteriorated over the last months. And if you say that the environment has deteriorated, you should say that should mean that investors will ask for higher equity risk premiums, and to get higher equity risk premiums, you either need bond yields to fall, but that's not the case right now, or you need expected equity returns to rise, and for expected returns to rise, you need lower valuations. So from that point of view, that explains why we have hedged part of the equity exposure we prefer to hedge part of the equity exposure rather than sell individual names because, again, we are a big believer in stock picking and think that generally speaking, the names in our portfolio, we're happy to own them and don't want to sell them completely. Bonds, I'm often saying that my allocation to bonds in the current environment will be between 5 and 15%, so I'm at the low part of that range. But I must say now that the 30-year bond yield is approaching 3% again, bonds for me, long-term bonds start to look attractive again. You know that for the moment my bond exposure is taken by buying long duration US treasuries. So now we see US treasury at 3%. That might start to look interesting again. And so if interest rates will continue to, if bond yields will continue to rise, then the bond allocation will be increased. Precious metals, so gold companies, again, the allocation typically is between 5 and 15%. Here, contrary to the bond allocation, I'm near the maximum because I think that generally speaking, the environment for gold continues to be structurally positive. So I still want to be exposed to the gold equities, and then the fund holds currently around 9% of its assets in cash. Just to come back to this historic asset allocation and to the hedging here, you see that's the gray line, so the fourth line, if you want, from top. As I said in the past, so I'm hedging from time to time. Normally, I only use this hedging possibility to hedge the portfolio against a very well-defined short-term risk. So when you look here at the graph in 2016, that was before the Brexit, and after the Brexit, the hedge was closed again. Then 1 year later, I did it before the French elections, and then after the French elections, I closed the hedging again, and then I didn't hedge again until the pandemic. And there it took a little bit longer to close the position because the rebound in equity prices was so strong and so quick. And then again, no more hedging until now, recently in March of this year. I'm always saying when I hedge, I sell futures on some of the equity indices, and which means obviously that given our investment style, our equity investment style, that usually then means that I'm short certain sectors because we typically don't invest in certain sectors, and I'll come back to that in a few moments. As I said before, so I think that stock picking will become even more important going forward. I'm not necessarily very optimistic about the outlook on the equities indices as such, but I'm still optimistic about the outlook for individual companies. So our way of investing is always this idea that we consider the purchase of an equity as a long-term participation in a company. So what we try to do is find good quality companies and basically try to avoid paying too much for their shares. And what I mean by good quality companies for us means that these are companies that have something that allows them to differentiate themselves from their competitors. And by being able to do that, and we often call this something a competitive advantage. So by having a lasting competitive advantage, these companies are able to enjoy higher profit margins, generate higher profitability, more free cash flow. By generating a lot of free cash flow, they are able to finance themselves, so they don't need to take on a lot of debt, so they have better balance sheets, etc., etc. These are the companies that we are typically looking for, and it's very important, and I think it's even more important in this environment because, again, as I said before, we have more inflation, and higher inflation means that the cost of production for a lot of companies are increasing, and then you have to make the distinctions. There are companies which are able to pass on their higher costs to their customers by raising their prices, typically the companies that we call the price makers. And then there are companies which are not able to do that, and so they have to absorb these higher costs by accepting a contraction of their profit margins, and then in the end of their profits. And so that's as a price takers, and we try to avoid the price takers, so we typically only invest in the price makers. That's very important, because the price makers often are in sectors which are associated with the growth style, whereas the price takers are more on the value style. I know that value has recently outperformed because investors have this Pavlovian reflex, by when they hear inflation or high interest rates, they buy the value style. But fundamentally speaking, these companies are not very good protection against the environment we're in, because they typically need a lot of capital. They often have weaker balance sheets, so they have more debt, so they are more impacted by higher interest rates. They're typically not able to pass on their higher costs to their clients. So fundamentally speaking, these are not the best of companies to own in the current environment. So we stick to our type of companies. The pushback I get often is that our type of companies are quite expensive. It's true for some of them. So the challenge obviously is for us is to remain to keep on with our investment style, and then the challenge is to find the right companies which are not too expensive in the current environment. But we will not switch to something else. We will not suddenly start to invest in banks or telecoms, etc. So that's something I'm always saying. It's very important, and that's something that you have to know when you look at our equity portfolios. Typically, here you have different the sectors that you often find in the stock market. So typically, our portfolios are on the sectors that you see on the left. So consumer staples, consumer cyclicals, industrials, healthcare, technology. That's where we find the type of companies that we like. That's where we find the type of companies that we would call the price makers. And typically we're not on the right part of the graph, so we don't invest in banks and insurance companies, because we are unable to value the companies in these sectors. And then utilities, telecoms, auto producers, airlines, etc. Are sectors that we typically also tend to avoid. One has to be aware of that when one invests with our funds. So here you have then the sector allocation of the equity part of the BL Global Flexible. Beige is the allocation of the fund. Black is the MSCI World, and you see that what I just said. So we tend to be overweighted in things like consumption, healthcare, industrials, and underweighted in financials, etc., utilities, etc. Energy here on the left side. When you look at energy, energy here in my fund are not the typical oil producers, Royal Dutch or Total. It's the pipelines, it's commodity pipelines, Enbridge, etc. And these companies fit much more to our investment styles than the typical producers. Then you have the regional allocation of the fund. So again, the first one, the light beige, is the equity portfolio, and then the brown is the equity hedging. So the equity hedging, the 18% I was talking about, is partly in Europe and partly in the US. We typically don't hedge the Asia exposure, first of all, because our portfolio is very different from the indexes, and also obviously you have the time lag, etc. And then the other parts, which are mainly so the bond and gold part, which is mainly in North America. You can see here, when you look at the equity portfolio, that compared, let's say, to an MSCI World, we are over-invested in Asia, including Japan. So the two together, Asia ex Japan and Japan, make up for some 27% of the fund, whereas US only makes up 18%. So from that point of view, compared to an MSCI World, whereas US often is more than 60%, we are under invested in the US and over invested in Asia. Why? Because it has, to a certain degree, it has to do with our contrarian approach. Asian markets have underperformed quite a bit over let's say, since the beginning of last year, and so valuations are often much more attractive than, for example, in the US, which has been the big outperformer. And given that valuations are for us very, very important, so it's for us to some degree, it makes sense to have increased the Asia exposure over the past months, and maybe having a little bit less in the US market. Here you see this underperformance. This is without Japan. So black is the MSCI Far East ex Japan, and brown is the MSCI World. And you see that beginning of last year, the February of last year, Asian markets have underperformed quite a bit. Part of the reason obviously is China, but there were other reasons. Often when the dollar is strong or when commodity prices are strongly rising, sometimes the Asian markets tend to underperform. So from that point of view, the underperformance to a certain degree is not that surprising. But again, it leads to interesting opportunities for a stock picker in these Asian markets. Japan is anyway a market we like quite a bit, also for top-down reasons. It's a market which the valuation is attractive. The company's profitability is structurally increasing. So a lot of positive things are going on in Japan, but it remains quite a cyclical market in the short run. Maybe just 2 words on ESG. So the ESG component is becoming more and more important also in our portfolios. The fund, the BI Global Flexible, has now gotten the French label ISR label in March. So when it comes to ESG, so the ESG is integrated at different levels, pre-investment, intra-investment, and post-investment. Maybe here just one point which is important to know is that the ESG profile of a company is directly integrated into our valuation models. By that I mean that companies which have a very good ESG rating, they have we integrate that in our valuation model by reducing their cost of equity slightly, which then means obviously that their intrinsic value, their value rises because you apply a lower cost of equity. And the companies where the ESG profile might be not so good, these companies are then penalized in the sense that their cost of equity is increased a little bit, so which lowers their fair value, their intrinsic value. So that's maybe something that's very important. Then there are other factors which are important when it comes to ESG that you find here on this slide. Also, what the fund is aiming to do, because when we applied for the ISR label, a French ISR label, you have to give clearly, you have to say, okay, the E, S, and G, but where do you really want to outperform? Where do you want to see your fund doing much better than the index? We set it in terms of carbon emission intensity and the social controversy score. So these are the 2 factors where the fund needs to outperform, and has clearly said that we will strive to continue to outperform in these 2 areas. And this type of report you'll find nowadays also in our monthly, these type of numbers you'll find in our monthly reports. Maybe to come back slightly to gold. So gold, as I said before, I think that's an environment, we are still in an environment which will remain structurally positive for gold, even though from time to time there might be some corrections in the gold price. So gold this year has done quite well. It has played its role in the sense that it has hedged the portfolio a little bit against the drop in stock prices. And then the gold miners, sometimes when you look at the gold companies, their correlation with the equity market is stronger than with the gold price, but that has not been the case this time, in the sense that the higher gold price over the first quarter has led to the index of the gold miners going up by some 20%. And so from that point of view, again, the gold position in the fund has clearly played its role over the first quarter. And again, we still very positive on gold, and then by definition also positive on the gold companies. You see here that despite this rise of 20% over the first quarter, the gold miners index is still very much below its level of 2011, when gold also was trading around the levels of $1,950 per ounce. So again, a sector where we still remain quite positive on. This is this slide that I'm sometimes using. Again, it's this idea to find a good combination between risk on, risk off assets. Here, what I did here is basically since I started in this business to look at the major corrections in the S&P 500 index, and you see that on average during these periods, the S&P lost a little bit more than 22%. And during these periods, US Treasuries and gold tended to protect the portfolio to a certain degree by having a positive performance during these periods. And again, the whole idea of the Global Flexible Fund is based on this idea to find the right combination between attack and defense, risk on, risk off, and so as to be able to generate a decent performance over the medium to long term, but also to protect and to limit the drawdowns of the portfolio during more difficult periods. Here you have the top holdings at the end of March. You see that on the right side, obviously bond portfolio, there were only 2 positions because, again, as I said before, I tend to only buy long-dated US Treasuries. Last year, I also had some inflation index bonds, which did very well. So I took my profits at the end of last year, and I'm now waiting to buy them back because they've corrected quite a bit this year. So 1 or 2 of these positions might reappear in the portfolio, but fundamentally speaking, the bond portfolio will always be limited to 4 or 5 different positions because there's no need to hold to buy 10 or 20 different US Treasuries. On the equity side, Roche in Switzerland remains the biggest position, followed by Franco-Nevada, so one of the gold companies, royalty companies, and then you see the other names in the portfolio. Alibaba, you see here on the 5th position, so we were, or at least we took advantage of the strong fall in the equity price to increase our position. We think that unless you consider the Chinese market as being uninvestable because of lack of protection of shareholders, etc., unless you have this attitude, then Alibaba, as the valuation of Alibaba has become quite attractive, as that's the reason behind the slightly higher weighting now in that company. The other companies, again, Franco-Nevada, Wheaton Precious, Royal Gold, and Agnico Eagle are all gold companies, and then you have Roche, Nestlé, etc. Maybe one word about the currency allocation. I'm always saying we don't consider ourselves as currency experts, so we generally avoid making predictions about where the dollar is going, etc., because quite frankly, nobody knows. So there are 2 points, I think, which are important when you look at the currency allocation of the funds. The first is, again, here also some currencies in this balance. I'm striving for this balance between risk on, risk off, attack, defense. Some currencies play an important role. By that I mean that currencies like the Swiss franc and the Japanese yen often are risk-off currencies, so they tend to appreciate during times when equity markets do poorly, and so then act as a certain protection against the drop in equity prices. So these currencies clearly have an important role to play also as currencies within the portfolio. So that's first consideration. And the second consideration when it comes to the currency allocation is that the fund in the end is denominated in euros. The performance is calculated in euros, but you see that I have only quite a low percentage of euro assets in the fund because on the bond side I don't have any euro bonds. Gold obviously is not in euro, so there are some equities in the eurozone, but all that together only makes some 15%, makes up for some 15% of the portfolio. Given that euro is a base currency, I want to have a higher allocation to my base currency so as to avoid too much volatility coming from the currency side, and to get to a higher percentage in euros. So to take the percentage of euros up to some 30%, I need to hedge one of the other currencies, and the currency of choice then is US dollar. Why is US dollar? First of all, because there are quite a bit of US dollars in the fund, 25% in US dollars, and you could add the 5.6% Hong Kong dollars because they are directly linked to the US dollar. So that already makes some 31, 32%. Then you have some of the Asian currencies, which are to more or less to a certain degree linked to the dollar. So all this means that the dollar exposure of the fund is quite high. So I don't have any problem reducing that exposure to a certain degree, and by reducing the US dollar exposure, increasing my euro exposure. So that's the reason why some of the US dollar exposure is hedged. It's not because we have a particularly negative view on the US dollar. It's simply this idea again of balance within the fund. So that basically concludes my presentation. Maybe just one word in the end on the performance of the first quarter. So during the first quarter, when you look at what contributed in a positive or negative way to the performance in absolute terms, you could say that bonds obviously were negative, but again, my percentage in bonds is very low. And then on the equity side, Asia and Europe, and Asia including Japan and Europe, were on the negative side. On the positive side, you had equities in the US, which had a positive contribution to the fund in the first quarter of this year. Gold clearly was a major positive contribution for the fund, and then a third important contribution was on the currency allocation, given that the euro was weaker. That obviously was also helpful in this environment. So that's basically a little bit the idea about in terms of asset classes, what contributed positively or negatively. When you look at individual names, clearly the major winners, when you look at the top 10 positive contributors, you have basically the gold companies. Within the traditional equities, you have two names, Checkpoint Software, a technology company in Israel, and Nintendo in Japan, which were among the top 10 contributors. And then you have the energy pipelines, Enbridge, TC Energy, which were again amongst the top contributors. Negative, you had names like some of the Asian names, Kao in Japan, China Fire in China, LG Household in South Korea. You had some of the more defensive names in Europe, Unilever and Reckitt Benckiser were quite weak. Gilead Sciences, the pharma company in the US, was quite weak. So that was basically amongst the more negative contributors during the first quarter of this year. So I think I'll stop there and then maybe take on some questions if you have any questions. Thank you very much.
At the moment, we do not have any questions, but do not hesitate if you have any to ask them using the Q&A system. So Guy is able to answer them directly. Any case you have questions coming to your mind in the coming hours, do not hesitate to contact your sales representative. They will be happy to forward the questions to us, and we will answer them as quickly as possible. Well, in the meantime, I would like to thank you for participating to this webinar. Thank you very much, Guy, for this interesting presentation and your time you took to do it. Well, no questions, but a comment thanking you, Guy, for this comprehensive presentation. Well, if there's no questions, I think we can end the call now. Again, thank you very much. As I said in the introduction, we'll provide you with the link to the replay of this presentation and also written summary. Thank you very much for participating. Thank you, Guy, and I wish you a nice afternoon and end of week. Bye.
Bye. Thank you very much.